Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, April 9th, 2024. It is 10:29 a.m. Eastern Time as I'm starting the video, so we're about an hour into the trading day. And here's what I'll do in this one. It'll be another mishmash where I kind of just go over some of the things I'm watching. I'll hit on some recent trade ideas, give you updates there, try to cover the usual suspects, commodities, crude oil, natural gas. I want to do an update on the mining stocks and metals. Semiconductors, Intel throughout the other day, NVDA I want to cover, and a couple economic indicators. So it sounds like a lot of kind of is, but I'll try to cap it. Yesterday I think we're right around the 50-minute mark. Hopefully I can get this one done in that time or less. Start out with the stock market as I usually do. We've been going nowhere fast lately. Remember, this is the post FOMC range I measured the other day. Zoomed in so tight here. Remember, this is about a 3% range that we've been in. I should call it pre and post. 3.5% from top to bottom. That's this purple box. Really goes back all the way here too, if you want to include the range. So that's it, guys. We've been going nowhere fast lately, and just going sideways. And as I said, the very, very short term, since the post FOMC noise or pop is clearly a downtrend right now. As long as we remain below these previous highs, that one, and you have several right around or just above it. And so it's still my preferred and favorite scenario, but don't get married to any position, any trade on anything. But that's how I think it'll play out. So 5-minute chart, we had a rally right into some resistance today. The 5-minute charts for active traders, and get these little divergent highs and swing them and then rallies into resistance. It's a lot of noise. I'll be honest with you. This is just a sloppy range. But as I said, there is some definition when you turn off all the lines, as I just showed you. If you just kind of take a step back and look at the very near-term downtrend. Now, before there was kind of sloppy. And again, that was because this was right here. This was the Fed day. And as I often say, you're prone to whipsaws all day long leading into and after the Fed. So far, the initial reaction from the Fed, which was positive, was not the lasting reaction. That has been 100% faded and then some. So that goes to show that what I was saying before and leading up to it doesn't guarantee that initial reaction, which was bullish, wouldn't stick, but it didn't stick. So hopefully, if nothing else, that's a takeaway for those of you that are kind of new to this game of trading and investing, is that what may feel bullish and smells bullish isn't necessarily. It's just a market's overreaction. And then again, the fact that they fade it, a lot of buyers jump in with hopium that day, and now it shows you this is technical analysis. Those buyers, everybody that bought the Fed post-Fed meeting had been wiped out already on that. So again, nobody wins until this range is near term. Give the bears a victory, for taking that, fading that rally. But really, the big win comes when either the bulls or the bears can solidly take it down below the bottom of the range or above it. So let's not beat a dead horse. I've been covering that forever and a day. We'll jump all the way longer term. We still have those bearish crossovers solidly intact on the QQQ weekly chart. Been a great trend indicator. I've covered that a lot lately, so I don't want to spend too much more time on it. Let's now talk about the most important thing this week, or at least tomorrow, coming up. And that would be the economic calendar. Remember, you can access the economic calendar, and you go into the site, click on resources up here, down here, tools of the trade, click on economic calendar. It'll pull that up, and you'll see the whole week. And then you can click on the red starred items, or your market moving, potential market movers. And so there was jobless claims. Tomorrow is, what happened here? Let's refresh this. Yes, tomorrow is Wednesday, not Thursday. Thank you. So we have CPI tomorrow. CPI is a consumer price index. There's your consensus right there, month over month, year over year, excluding food and energy. So here's what I'm going to do. I've done this many times in the past couple years, especially since inflation started to be a thing for the first time in nearly half a century. Very much a thing, and it's what it's all about right now. The narrative kind of said it would shift to that if we got it, and we did. If we went down in my yellow and orange zones on Treasury bonds, you'd start to hear, everybody backpedal on a 180, which we've seen. Tremendous shift in the Fed expectations from both, especially what the street was initially expecting last year, and even what the Fed has. The Fed's cowed down on their previous projections. And so here it is. Let's just talk about what the consensus is for tomorrow. So core prices, core are the, what they strip out the volatile food and energy prices. And then, so here's what we're looking at. Consumer prices have come on the high end, blah, 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 blah. Core prices in March are expected to show a monthly increase of 0.3% versus the 0.4 increase they had in February. That's month over month. Overall prices, so if you include the volatile food and energy, are expected to also rise, 0.3% after increasing 0.4 in February. Okay, so the trend has been a little hot lately. And so here's what I'm going to do, which I've done many times in the past, and I like to go here. We go to DJP. It's a broad-based commodity tracking ETN. I'll go to this chart here. I've been doing this. It's going back here. And what I do with these boxes, I cover the entire month. So the outline of the box is the end of the previous month. So if you look here, I put my crosshairs up. You can see my pop-up box. That was the last day of. So everything included in the box. This right here, this first green candle is March 1st. There's the end. Now again, this is a broad-based commodity ETN. And as any broad-based, all the broad-based commodity indexes, I should say, have energy as the highest weighting, and it should be because it's also the biggest component of the CPI, and so rightfully so. And the good thing about that is like instantaneous. That should be priced in. When gas shoots up, from $60 a barrel. Yeah, you can have a little bit of variance in unleaded gasoline. We'll pull that too in a second. That's UGA, but it's a pretty immediate impact, and that's one reason they like to strip it out. So remember now, point 3. Here's what we're going to do. I'm not going to sit here and add up every data point. And remember, in here, in this broad-based commodity ETN, the things that other than gasoline and natural gas, the energy, which is again a big component of it, you do have food, but you have the raw inputs. You have the raw agricultural commodities, industrial commodities, and those have there's a little bit more of a lag on, I think, on the in agricultural commodities. Wheat can shoot up really high in a month or two, and it doesn't necessarily make a loaf of bread go up right away, because that's the loaf of bread's what's coming through in the CPI. But again, with the industrial metals, especially in commodities, yes, that does matter. If gasoline shoots up in a week, 10%, that's what you're putting in the pump. You all know this. Their gas stations are super quick to raise their prices when gas prices go up. They're a little bit slower to drop them on the way down. And so, anywho, so if you just kind of eyeball this, you don't have to be an expert mathematician, but you can just eyeball, where we were there. There was a pullback. So somewhere I would say safe in the midpoint if you want to take an average. And again, remember that the impact here on crude and energy and natural gas is more immediately reflected. This is last month. This is March. But there'll be a somewhat of a lag coming through in the other components, and of course there's services and all that other that's not included in here. We're just looking at commodity prices. However, with that being said, I'm going to measure from the bottom. There's where we closed the previous month, right at the bottom of this box. Take it up to the midpoint, and if you see a pop-up box on the left, that gives me an increase. I would say the midpoint's, because we hovered here on the high end of the range. This in the beginning of the month we shot up pretty quick. Then we went up there and we maintained on the high end. So I'm going to say, and just again, eyeballing this, that we're probably midpoint would be about there. And that's right at 3. If you look at the pop-up box on the left, 3%. Again, they're calling for a 0.3% increase in overall inflation, including food and energy. And I just showed you commodities went up on average, again, ballpark over the period of the month, closer to 3% there. Now, with the lag and on things, like I said, final cost, through gains in agricultural commodities and other things. You did have a few, but really, if you look back a few months ago, this was falling inflation. This is everything the market was cheering for and calling for all those aggressive rate cuts that they were calling for before. Inflation had been dropping. Prices were going down. But if you look back in December, we stopped. That's it. If you take an average there, you were probably there, average there, a little bit lower here. And so some of that, is going to weight this down. But bottom line is, now here's the problem. Everybody, there's a tremendous amount of criticism about the government's computation of the consumer price index. There's a site, was it Realflation, Trueflation? You can go there. They give you a better measure. Okay, so however, in the past, when I've used this, it's been a pretty accurate indicator. I've had to be able to call, if you will, the CPI, whether it's going to come in line, hot or cold, or with pretty good accuracy. And so I'm calling for a bump. Again, we'll see, maybe not. Now, I will say this. Check out what's happened since. Remember, we're going to report tomorrow. You're going to hear the March date. Look at April. We've shot up through there. So whatever comes in here, if it happens to come in at or somehow below expectation, just remember, then the lag of this will carry forward when they go to report April's, and you're going to see, unless something happens soon. Again, this is a broad-based commodity. This isn't just energy. And let's look at energy real quick. Let's look at crude oil. Again, one of the biggest components. This is why, we've seen, lower here, but this is the month of March, and that should be, again, more of a real-time thing. I don't know the lag. I'm not pretending to be an expert in the CPI. Just know that the market's going to be watching it. And then again, if you want to take a ballpark, so we spent the beginning of the month down here, then a sharp rip in the middle of the month, some consolidation in the middle of the range, and then another rip at the end of the month. So I'm going to put us right in the middle again. I'm going to grab the box. Again, this is the month of March. Crude oil prices via USO. That is a 5% increase. So if we come in at or below expectation of increase of 0.3 on overall prices, I'm going to call BS on that. But whatever. Let's see. There's that. And then if you want to look at gasoline, I told you we could look at that for kicks and giggles. March 1st is right here. So we started there. We had a little blip down in gas prices, but then a sharp ramp up. And I'm going to say I think it's safe to say we spent the majority, because you had just as much consolidation up here at the high end of the range for the month. I didn't box it, but you can, box is about right. Well, let me grab my tool. Somewhere like that. And so there you are. So gasoline, which hits everybody's pocket, is about a 6% increase in the month of March. So any way you spin it, this is the trend here. So we're trending up. No signs of a reversal yet. I told you before, and I'll say it again, I'm bullish and long natural gas. I've made that clear. But crude oil, you can take a hedge. I don't have a position in crude oil other than to say, if you want to, you could certainly take a hedge, a short on crude if you are short the indexes, because the market, again, should be a net positive if we start going down here. And the case can be made. I told you we had that negative divergence I showed you on the futures. Pull back to the trend line, but that's probably all it's going to be for now. And so if it plays out that way, if crude drops and the market does rally on it and you are short QQQ or IWM or anything else, then you should profit on your short on crude. And if you position size it correctly, it should offset any losses there. But I think I often use the analogy of a gunshot wound. Be it a person, a victim of crime, or a hunter. The gunshot doesn't always kill. If you get a heart shot, the deer is going to drop right there. You get a gut shot, thing's going to run off. And this is the damage. My point is, this is damage that is done. Even if crude right now dropped down and corrected back to this trend line or whatever, you're still at elevated prices. This is USO. You're still pushing prices that are near multi-year all-time, really, multi-year highs, not far off all-time highs. And that is certainly inflationary. So that's what crude looks like. All right, let's look at a few other things. Since I'm on energy, I'll just go to nat gas. I don't want to spend a lot of time on it because I've been updating that, because that's an active trade. Today we popped T1. Remember, we were long here off the lows, hit the first target, which is resistance, pulled back to what was my former first support resistance level, now support, gave us an objective re-entry there, and now we've taken out T1, so that should open the door to T2. And I was recently reading something that said despite the soaring crude prices right now, they really haven't ramped up drilling solely because natural gas has been so low. See, natural gas, and the more you're drilling, then the more natural gas is coming out of the ground too when you're drilling for crude. So, the fact they haven't ramped that up should, if unless that article is just some kind of false, if it wasn't accurate, but that should, as long as they're not increasing, it should keep oil prices buoyed somewhat and natural gas prices as well. So we'll see. Anyway, like anything, it's one trade. Don't fall in love with it. I'm going to talk on the GDX trade. The last update I did was, I think, 3 days ago. I said you might want to give another a little room on the stop, especially if you shorted here, because at that point we finally had a breakdown. We had a sell signal. We had the divergent high. And so I still like this one. And it has a lot to do with gold, too. You have gold. That was a breakdown I was referring to on gold. We went up, made a marginal new high on gold, and it's basically back tested. This is the trend line I pointed out the other day. We hit it, back testing again. The divergence is very much intact. And then more so, if you remember, about not even a week ago when I said the one thing about it is we had this bullish falling wedge in the euro, which broke out, and then I highlighted a couple resistance levels, which I said would most likely cap it. The uppermost, we had that trend line that was just hit. So there's that downtrend line off the highs, and it's not just been hit, but we had another reaction. I believe when I covered it, I said, look, we have a couple reactions. Now we have a fourth reaction to help define it. We also have even better negative divergence. Why am I talking about the euro? If you're new to the site, the euro and gold go hand in hand. They're highly correlated. There was a little disconnect recently, which was unusual, but if you go back years, go as long as you want, this chart is the euro against the dollar. So when this is going down, the dollar is going up. And then, so gold moves positively correlated to the euro, negatively correlated to the dollar. So if that goes down, that should bring gold and silver down with it. So I just wanted to reiterate that personally, I'm, like I said the other day, might want to give it a little room on the GDX short trade. And that's, of course, after closing out the long just a couple weeks ago. We were long into T4. I don't know if you heard the little alarm go off about a minute ago. It was a price alert. Popped up on another monitor. It's this one. I like to check the alerts when I'm doing the videos if they go off. AMP, Ameriprise Financial. I had lines here drawing potential divergence, which is now confirmed with the bearish PPO crossover, just starting to crack. So that's how the line should be. I tightened it up nice and tight. That is a breakdown. There is a short right there, an entry on AMP. I would, so might as well throw the idea out to you. I can see a couple stops along the way. If you want additional targets, just bump me. I'll give you some near-term targets, which I'm doing right now. But I like, at minimum, I think this level. And a lot of things, I'm calling them back, just like the markets. I'm calling a lot of things back to the 200-day moving averages. So, if you want to just swing it, should take us down about 13% on AMP, and it's an asset management company. So I'm sure if I go through the rest of them, I'll see quite a few that also look ripe to pop. That's asset management. That wasn't part of why I did this video. I wasn't going through I didn't intend to go through the asset managers. I'm just clicking the button on my watch list now. So I click my little space bar. It'll show different ones. I'm just trying to eyeball. This is how I'll quickly go through a sector. Sometimes pretty fast like that. And, I probably not calling out what I see, but I see a lot of similarities. I look for divergences, uptrend lines, wedges, other patterns, horizontal price support and resistance. I'll have to revisit that later and dig through all the components and see if I can come up with some ideas for you there. So let me just check my watch list. I covered commodities, gold, crude, GDX. Oh, let's talk on semis. Intel threw that out as a trade idea the other day, and I was very clear that it wasn't my favorite. I wasn't so hot on it because I've been short the semis and bearish the semis, but threw it out to you as an objective entry here at support. and down to, but not below the uptrend line. That was where I said it would be the entry zone if you're interested in those looking to go long Intel. We've taken out the trend line right now. The day is not over. You may want to use a daily close, but looking at it, I'm going to move this line up right here, guys. I'm doing that because it's an old chart, or a lot of these lines are old. I have 1, 2, 3, and then another, call this 3 distinct reaction highs, 37.20. So if it can, it pop and get back on or above the trend line, it may hold that by the end of the day. But it's stretching everything. It's stretching that trend line. It's stretching the divergence. And so I would not get married to this one, because if the market's going where I think it's going and the semis are going where I think they're going, then this one's going to go down despite, it's just, you can see, here's a good example. So support right there, the 200 days, it just sliced through them like they're not even there. And that's what I've been talking about for a couple months now. And I know most I can watch, the replies to the videos are getting fewer and fewer. There's still a handful of, angry bulls, comments on the site, but that's even dying down. I think most have given up. But my point is, if we do break down and get those sell signals I'm looking for, and I've said this many times recently, I just want to reiterate it so you kind of know my game plan, is that I think we can go on quickly through the initial support levels, sometimes like they're not even there. You'll see that. So 433 is still the magic number, kind of with, contingent on some other things. I want to see some of the key sectors also break support in the S&P 500, the top 4 sectors, at least the majority. The big market leading stocks, I'm going to get to NVDA in a second. And so again, I have if that happens, I most likely on my swing short positions, most likely will be sitting tight and just riding out any reactions if we get any, and wouldn't be surprised if we slice through the earlier ones if that's the case. So, I'm still holding out. I have my eye on the prize, but I also am waiting for that all-in moment to get aggressively short, or stop out. If we keep going up there and pop through the top, then, I still have it's just been grinding around for months. I'm virtually break even on it from where we had the other entries, maybe a hair underwater on the initial cost basis there. No, because I've added up in here, and again, and sometimes I'll even swing and then active trade in the same account, reverse that out. So I can't, it's like doing Chinese math to figure out. There's no one position, in other words, when you scale in. When you're active trading and you're on these 5-minute charts, those are single positions. They're in, out, they're in, out, in, out. When you're swing trading and trying to call a turn, whether it's a bottom or a top, and you're doing what I've been talking about for months now, building a position, scaling in, but waiting for that all-in moment to go to full position, then the entry prices are variable, or it's an average cost. Okay, so you have the update on Intel, but let's look at the semis, and then more importantly, the king of the semis. It used to be Intel, and not even that long ago. A few years ago, Intel was the king of the semis, and it's long since given up that title. It seems like it's been forever now. No change in SOXX and semis. Big bearish engulfing candle still mark the top. Like the Nasdaq 100, because it is a tech heavy. Semis are tech. They've been grinding sideways. They've taken out the BOD, or benefit of the doubt, the secondary trend line after taking out the first one. Still got that first, second, third target. Third target still lines up with the 200-day moving averages roughly. And so still looking for a drop of 20% or so minimum in the semis. And I have not abandoned any of my longer term targets, but this charting platform has ruined it with the split in SOXX, so I've got to retask these all these price targets that I had set up for you. Really, just going back here when the semis first peaked, we shorted them back there, and they dropped 44, almost 50%. So, but it's still this trend line. I moved it down. I'll keep it very simple. That's the longer term target. And if you wonder how I can be calling for such an aggressive target. Remember that the charts are stacked, is what I like to say. There's big negative divergence here on the weekly chart. So what happens is, by stacked means It's kind of something I made up that, if we happen to, let's just go with this, and we hit my third target here. Okay, Randy, I'll give you that. We're going to correct semis are a pot. Well, then you get down there, you're going to get down to about 180, and you're going to get down there on the weekly chart, and that's going to then cause a lot of these indicators to roll over, confirm the divergences, give you bearish crossovers, maybe even take out, probably put a trend line right there. Again, so that seemingly, innocuous, if you want to call it, what is that, 20% drop there can actually trigger some longer term sell signals on the longer term weekly and maybe even monthly charts. So that's how that works. Nothing's a straight down drop. There'll be plenty of things to game, and who knows, maybe we get down, maybe we never get there, but maybe we get there, and then I go long for a run to new highs based on whatever's going on in the charts and interest rates and the US dollar and treasuries and blah blah blah. We'll see, but that's not right now the current plan. Oh yeah, so let's get to the lead dog, lead sled dog there. Ooh, look at that, nice. Earlier, before I started the video, we weren't there yet. So 840 is taken out. Remember, I've been highlighting that recently as the next level to go. Still have, and it's, almost colored it up yellow, but I'm going to leave them. I'm going to be consistent. There's my yellow line, still 742, and it's the purple line, which is even much, much more significant. I know this is a busy board. If I turn off all the lines, I'll just draw it out for you. This is your primary uptrend line. It is a very significant trend line in my opinion. Comes off the October 22 lows. You have 1, 2, 3, 4, 5 distinct reactions. At minimum, I think we're going to come and revisit this trend line. So if you're, super bull and you think NVIDIA is going to continue to go to the moon and be 3,000 or whatever, whatever they're calling for it, then that would be a great level for you to buy if we get there. If you're bullish, hey, look, 840 support. This is just an intraday break. So what's going to happen if this is not NVIDIA's time yet? Then they're going to rally it up and close it back on or above 840, and then so you can buy it at support. Now, the way it works for me, you don't buy a break of support. You wait for the recovery back above support. That would be more objective. There's only one move at this point as I speak on the video, and that is to short it. But you might want to hold off on that if you're, not an aggressive trader. Because we're just slightly below it. If I have to zoom in like this, I always say, and you have to squint to see it, we're at 834.13. You might say, oh, yeah, that's 6 points. Well, 6 points on an 840-point security is virtually nil. But it's a breakdown. See how it closes. As I like to say, the redder the better. So if this is how this candle looks at the end of the day, you got the 50-day moving averages there. You got the 50s, both the 50 simple and exponential. Next support 742, then the uptrend line. And then got the CPI tomorrow, so I don't expect any big fireworks today. It'll probably be like yesterday. The market kind of grinds around. We're down a little bit now, but nothing big. Either way, just wanted to update in the video for you, and that's the big one. And then my favorite, which is, the semis, still SMCI. And shorted this one, or I posted shorting it here and for you guys there. And also here, we've had 2 objective short entries. You had a bearish engulfing candle. We went a little higher, then we broke down right here. And that was a bearish rising wedge. That's this thing here, divergence, negative divergence, which was what was lacking there. Then you got put in the divergent high, and then you broke down. It's been impulsive. And again, it's a near-term downtrend. This is an intermediate to longer-term uptrend with a near-term downtrend. And once we take out, if and when we take out that low, that'll keep that downtrend very much intact because you'll now have a lower low. And then you can see 811.50-ish is support. If that goes, that should open the door to 690.50-ish right there. Minor support, really. Like I said, this one's just a lot of thin air. Down below to my price target here of 355.60. So at this point, you want to have a nice stop, a very objective stop. I'd say a solid daily close above that downtrend line. You also have a reaction high there. So this was what would be bullish technically. A break above the downtrend line, solid close above it, especially a close above this previous reaction high, because there's just not a lot of resistance still there. And that's certainly a possibility. You can have the PPO still above the zero line, and if that happens, I can tell you right now. Then if it does this, you might not want to ride out to a new high, especially if everything else is confirming. The semis look good, the market looks good, QQQ breaks upside of the trading range. But if it were to happen, if I can get my arrow tool here, it might be months, and then we'd put in this divergence. These indicators are severely lagging. That means that it would take a while, but you'd get a new high, and if it happened anytime soon in the next few months, it would still be a divergent high. However, we already put in a divergent high, so that doesn't have to happen. Could, may not. That's how we say the charts are dynamic. Therefore, so is my analysis, meaning they change on a daily basis. Every day, technicals look a little different. New trend lines form, new price and support and resistance levels form. I'm going to give you one other level here that also looks like a good stop now. I picked that because you had that top of that bearish engulfing, then you had quite a few reactions right in here, and then you broke that with an impulsive candle and you rallied back to it. So this seems to be about the magic number, about 1090, 1091, pretty good resistance. So that's where I think an objective stop makes sense. And there's still plenty of meat on the bone. If it is going to my price target, there's still 60% downside. I'll take that all day long. You can short it here, give yourself a 10% stop loss, or even that 20. Now you beta adjust it. How does that work? You might say, Randy, you're crazy. Why would I give myself a 20% stop loss up to that 1090 level, above that? Well, because you're going for a 60% profit. That's a 3-to-1 RR. You can give yourself a 25% stop loss and still have a favorable, better than a 2.5+% RR. Thing is, you have to beta adjust your position size. What does that mean? If you're new to the site, go here, go to resources, or right here, that calculator thing. You can click on that as well. It's on there. Position size calculator, and then it says, all right, what do you usually do? You usually take 30,000. Whatever your number, 3,000, doesn't matter. We'll just do 10,000, so round number. And then you can see that SMCI is, you're looking at those big targets. The beta adjustment's a lot more. So let's say you do a half a position size. So half of what you'd normally take. It says instead of putting 10,000 like you would in QQQ, you might only want to put 5,000. And it's a short trade. You short it today. It's at 889 almost, and you're going for a target at let's say 356. And so stop would be at what I say 1090. We'll go 1095, a little bit above that, and that's going to tell you that the risk reward ratio in that one is 0.5 to 1. Nope, that's what I did wrong. Stop price. We had 1090 before, or whatever, and round that up, give it a little bit, go 1095. There it is. There it is. 2.6 to 1 risk reward ratios tells you, again, if that's your number, take short 6 shares if you're successful. And that's, again, not that's from where we are right now, not from the previous short entries, which would be better. That's 60% profit. Tells you you'll make $3,000. If you're stopped out, you're going to lose 23%, which is $1,100. So great tool. And then this part here, for those that want to, let's say QQQ, it's your thing, and you're looking to go what I call an all-in. All-in's not 100% of your portfolio. So let's say you've got a $100,000 portfolio, and you want to put you want to short Qs. You want to push it hard, 30% of your portfolio. And you're going to short QQQ, and you're going to short it at 432 when the 433 level breaks, and you're going to, what's my price target? So I got to look at another monitor here, down to those 20-day moving averages. I was calling for down to T4. I'll call it 395. Let's be conservative there. 395 is your price target. And then you can do it this way. You want to use 3-to-1 RR. Let's see if it populates this way. It's been a while since I used this one here. 3-to-1. Nope, that's not working. So stop price, you just got to play around with it, and you can put on, let's say, 440. No, if we go back above, if we break 433 and get solidly back in there, so I'm going to do 438. We'll just pick that. That's giving you a phenomenal risk reward of 6.2 to 1. Tells you that you want to, you'd go short 5,000 shares of QQQ. Again, if you wanted to put 30% of your account in there, percentage of, yeah, that was right. Here it is. So yeah, $100,000 account, you risk 30% of your portfolio. You're risking 30,000. So there it is. So there's your amount. If wrong, you're going to lose 1.4. So what that was based on this. If you follow me on that QQQ trade I talked about, the swing trade. This is the shorter term swing trade. We shorted the Fed, post-Fed pop, we're swinging that down. But again, as I said, if we get there, I think we're going to break it. You got the 50-day coming in as well. Algos are going to sell. They should dump the market if the 50-day and 433, which coming together, are taken out. And then, so what I was doing is using this as a target. That's what I plugged in there. And so what I was saying there is what I did in that format. If 433 gives way, I said put a stop at 430. It's pretty liberal. If you get back, we're at 439 right now. That means you'd be back to almost this level here. And that means it'd be a whipsaw. So at that point, you have to recognize the breakout failed. Doesn't mean you can't do that and then go back down. It just means somewhere you've got to manage your risk. And if we break 433, it's a solid break. And then all of a sudden we snap back up there that day or the next few days. That's bad. And we're probably going to most likely go back up to the top of the range and beyond. So that's why I used those formulas there. So that's a trade. That's how, figure out how to, and how much you want to put in, and your number may be a lot different from that. Remember, QQQ, it's not a very diversified index, but is diversified among 100 positions. It's just very tech heavy, and also take into fact other things, like if you, for example, were to short QQQ, 1, 2, 3, you got the triple Qs, 1, 2, 3, and then you also decide you want to be short SOXX. Just know this, that you have a tremendous amount of overlap, because in QQQ you have it's chock full of semiconductor stocks. So that is an overlap trade, and you're just going to have to factor that in and say, okay, overall, how much do I want to be exposed to tech and semis and all that, and then figure that out. Okay, guys, I'm going to stop it here. I'm at the 36-minute mark. That's not so bad. This was at rally into 433 resistance. All these levels here. It did it with another divergent high. It's shot down. And so far, again, we still need to, bulls want to see this level taken out right there. Bears want to see this low taken out. If they do, I said, this trading range is getting long in the tooth. We'll see. Tomorrow's CPI report certainly has the potential to make or break this. And remember, too, you're going to see that comes out at 8:30. QQQ will almost certainly gap up or down. Depending on where we close today, we could be in close enough proximity to gap down below the bottom of the range. We could even be in proximity. It's a tight range to gap above the range. Here it is on the 15-minute chart. So just know that if you are a swing trader and you are trading QQQ, whatever you go home with tonight is what you're stuck with. And if you're long or short, you're either going to be most likely pretty happy tomorrow morning at 9:30 when the market opens, or not so happy, depending on how you're positioned. So the old saying in Wall Street is sell down to the point at which you can sleep at night. And, as I've said over and over and over, if you're getting frustrated because you're long and bullish and the market's not going anywhere, that's just the nature of a trading range. We're going sideways. Same thing if you're a short seller and you're waiting for the market to go down. This is it. And the good thing is no trading range lasts forever. Sooner or later, this thing will break one way or the other. Hopefully it won't be a whipsaw and whips us all around. And if it does, it's just part of the game. You just have to pick up the pieces, position accordingly. Don't fall in love with your trade. If it goes against you, like I said, the most bullish thing would be a false breakdown followed by a solid recovery, while a same thing holds true on an upside break followed by a downside. One thing I'm going to say, I didn't mean to, told you I'd stop the video, but I do want to say that Treasury bonds are still, this is IEF, this is the 10-year bond, still has this positive divergence. And so when I look at this, I would say if I had to flip a coin, I would say the market's going to somehow rally on what the CPI does tomorrow, because this looks like Treasuries certainly have the potential to rally. I always say divergences are not a buy or sell signal. And if it's truly, if the market's really going to get surprised here, because it's been extremely resilient, the stock market has, even relatively shrugging off this tick up in rates and these changes in interest rate cut expectations. I got to give it credit, especially the S&P 500. But and so if you get something that the market likes with CPI, that could bring bonds back up here. However, if these divergences fail to play out, to me that's very, very bearish. If we move back down further in the orange zone and you just see these divergences get taken out, that's kind of a get out of Dodge moment, in my opinion. I just wanted to point that out. So again, it's another way to hedge up. If you want to have an indirect hedge, if you are carrying a short position into tomorrow's CPI data report, you could go long treasuries. And so if treasuries go up, you'd probably want to take roughly twice 2.0 beta adjusted position size at least. And you might even want to go with the long bond, because the long bond is going to get more juice. That's the TLT, the 30-year bond here. You have the same divergences there. And where to, if we do pop after the CPI, there's a beautiful downtrend line right there. If we do that, not going to be so good for the stock market. If we go down, these divergences get taken out, and we go down my next target zone here, oof, that would be quite bearish for the stock market. All right, so stay flexible, stay nimble. I wouldn't go home too crazy long or short into tomorrow unless you're just a gambler. And if that's the case, go to Vegas. You get a free drink out of it. Like I said, if I had to bet, and I am betting, I'm going to keep that core, initial starter short position into the FOMC, into the, the CPI tomorrow, but nothing heavy, nothing crazy. After it's over, and we'll see which way the market's going, then I'll decide to add or subtract to that or just sit tight. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.